Welcome to the Lowdown. I'm Adam. Today we're talking about the most expensive mistake in investing, the sunk cost fallacy. The reason you hold losing stocks long after you should have sold. And more importantly, how to stop. On a Tuesday morning in August 2015, Bill Ackman, one of the most famous hedge fund managers on Wall Street, walked into his office at Pershing Square Capital Management and looked at his screen. He was staring at a position worth over $5 billion. A bet on a pharmaceutical company called Valeant. He had bought in at around $260 a share as the stock climbed higher. When it hit $257, he was up. When it started to fall, he bought more. And more. And more. By the time the crisis was over, Valeant had crashed from $257 to just $11. Ackman lost nearly $4 billion. $4 billion. But here's what's haunting. Ackman had multiple opportunities to sell. In the early days of the decline, he could have walked away with billions. Instead, he held on, and kept buying. And when journalists asked why, his answer was always the same: I've already committed so much. I can't sell now. The thesis is still intact. And that exact sentence, is the most dangerous phrase in investing. Economists have a very simple rule. It's called the bygones principle, and it goes like this: the only costs that matter in any decision are the ones you can still avoid. A sunk cost is any cost that has already been spent and cannot be recovered. The money you paid for a movie ticket you hated. The 3 years you spent in a career you despise. The stock you bought at $100 that's now worth $40. Here's the mistake: your brain treats that $20 as if it's still yours. It's not. It's gone. Economists call it a sunk cost, and they say it should have zero influence on what you do next. And yet, we all violate this rule. Constantly. We stay in bad relationships because of the years we've invested. We finish terrible books because we're already 100 pages in. And we hold losing stocks because selling would mean admitting we were wrong. The sunk cost fallacy is when you continue an endeavor, not because it makes sense going forward, but because of what you've already put into it. You throw good money after bad. You dig the hole deeper. You tell yourself, I can't stop now. And in that moment, you are making a decision that no economist would ever defend. In 1962, the British and French governments signed a deal. They were going to build the world's first supersonic passenger jet. A plane that could cross the Atlantic in 3 hours. It would be beautiful, futuristic, and, as it turned out, a complete financial disaster. The initial budget, £70 million. That was the estimate. By the time the Concorde took its first commercial flight in 1976, the cost had ballooned to nearly £2 billion. Adjusted for inflation, that's about $4 billion today. Here's the thing: both governments knew within 3 years, that this plane would never be profitable. The 1973 oil crisis made the math even worse. To break even, they needed to sell about 100 planes to airlines around the world. They built 14. No airline except British Airways and Air France ever bought one. Most flights flew half empty. And the Concorde, that magnificent, thrilling machine, never made a single dollar of profit in 27 years of flying. So why did they keep going? Because by 1965, they had already spent so much that canceling felt impossible. The British government privately admitted the project was a disaster that should never have begun. But they couldn't stop. The money was already spent. The national pride was already committed. Every year of investment made it harder to walk away. For investors, the lesson is brutal. The Concorde flew for 27 years and never made a dime. Your losing stock doesn't have a government subsidy keeping it in the air. So why do we do this? Why do intelligent, rational people hold losing stocks until they're worth pennies? There's a science to it. And it starts with 2 psychologists named Daniel Kahneman and Amos Tversky. In 1979, they published a theory that changed how we understand financial decision-making. It's called prospect theory, and its central finding is this: losses hurt roughly twice as much as gains feel good. That's called loss aversion. And when you're holding a stock that's down 40%, your brain doesn't see a rational question like, should I keep this? It sees something much more primal. It sees pain. Your brain treats an unrealized loss, a loss that's still just numbers on a screen, as reversible. You haven't lost yet. There's still hope. But selling? Selling converts that paper loss into a real, permanent, concrete loss. And that feels awful. The anterior cingulate cortex, the part of your brain that processes physical pain, lights up when you contemplate selling at a loss. Then there's self-justification. In 1976, a researcher named Barry Staw ran a famous experiment. He gave participants a choice: continue funding a failing project, or cut it. The result? People who had personally chosen the original investment were twice as likely to throw good money after bad. Twice as likely. Because if you chose it, stopping means you were wrong. And your ego will do almost anything to avoid that. There's mental accounting, too, a concept from economist Richard Thaler. We mentally label money. This is my tech stock money. This is my retirement money. And selling a stock means closing that mental account at a loss. We'd rather leave it open, with the hope of breaking even, than close it and mark the failure. The psychology is layered. Loss aversion, self-justification, ego, mental accounting. Every layer makes it harder to do the one thing that makes sense: sell. Let's look at what this costs real people. In 2000, Enron was the 7th largest company in America. The stock traded at $90 a share. Employees had their retirement accounts loaded with it. Institutional investors held millions of shares. When the accounting scandal broke in October 2001, the stock began to fall. And a lot of people held on. They had held Enron for years. It had been a great stock. The losses had to be temporary. By November, the stock hit 26 cents. A 99.7% loss. Most of that value, most of it, evaporated in the final weeks, when selling was still possible but psychologically hardest. Think about the Enron employee who held from $90 to $80 to $50, telling themselves, I can't sell now, it's too late. At $80, they had a decision to make. At $50, a different one. And at $10, a third. Every single time, the only rational question was, if I didn't own this stock today, would I buy it at this price? And every single time, the honest answer would have been no. This isn't just about extreme cases like Enron. Academic research shows that individual investors systematically hold losing stocks too long. A landmark study by economist Terence O'Dean found that investors sell their winners about 1.5 times more often than they sell their losers. This is called the disposition effect. And it costs the average investor between 3 and 4% in annual returns. 3 to 4% every year, just from the decision to hold losers instead of selling them. That's the difference between a good retirement and a great one. And the cause is not bad analysis. It's not bad stock picking. It's simply the inability to let go of what's already gone. So how do you stop? How do you actually break the sunk cost trap? Strategy 1, the outsider test. Ask yourself this question, and be honest: if I didn't own this stock right now, would I buy it at today's price? If the answer is no, sell it immediately. The fact that you used to own it at a higher price is irrelevant. That money is already gone. The only question that matters is what you do with the cash you have today. Strategy 2, pre-commit to your exit. The single most effective defense is to decide your exit before you enter. Set a stop loss. Write it down. Commit to it when you're cold and rational, not when you're watching a stock fall and your brain is screaming hold. When the decision is made early, it bypasses the emotional circuits entirely. You're following a rule, not making a judgment under duress. Strategy 3, reframe with opportunity cost. Instead of asking should I sell, ask what else could this money do? Every dollar locked in a losing stock is a dollar that can't be in a better investment. The money you lose by holding is the sum of everything else that money could have been. Strategy 4. Kill the mental account. Stop thinking about this stock and that stock. Think about your whole portfolio. When you close a losing position, you're not admitting failure, you're freeing up capital for a better opportunity. The only score that matters is your total net worth, not whether any individual trade was a winner. 4 strategies. They all lead to the same place. Stop looking backward. Start looking forward. Let's go back to Bill Ackman for a moment. Ackman ultimately sold his valiant position. He lost nearly $4 billion. And he later admitted, publicly, that he should have sold much earlier. He said the mistake was not the original investment. The mistake was refusing to admit it wasn't working. Past money is dead money. You cannot get it back. You cannot earn it back. You cannot trade your way back to it. Every dollar you've lost is gone. And the only question that matters, the only one, is what you do with what you have right now. Every great investor, every single one, has taken losses. The difference is they take them fast and small. They don't let a $5,000 mistake turn into a $50,000 mistake. They don't hold a stock to zero because they can't bear to sell at a loss. The only moment that matters is this one. What do you do now? Thanks for watching the Lowdown. If this episode helped you think differently about your portfolio, subscribe and we'll see you next week. Until then, remember, past money is dead money. Future decisions are all that matter.